Welcome to the Organized Investor PodCLASS with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. Think of these pod classes as a college of knowledge, and the curriculum is an inside look at how we work with our clients to organize their investments, their retirement, and their affairs. Our process is certainly not the only approach, but it has served our clients well. Listening may materially improve your life as well, but for that to happen, it also takes an open mind, an interest to learn, and your trust in what we're sharing. We focus only on what is relevant and will explain things several times in different ways over multiple classes to ensure you understand their importance. We suggest you subscribe so you'll receive reminders about the next class. And with the tools and information on our website, theorganizedinvestor.com, you can start getting organized right now.
Welcome back, students, to what is our 18th PodCLASS and the 12th in a series on the subject of organizing your investments. And after watching a massive number of legal shows, movies, miniseries, all the things, we've actually learned that if the discovery process is good enough for Perry Mason to compile the facts of a case, it's good enough for us.
Dun, 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 dun.
I don't think that was Perry Mason's theme song, but
I know, but it's all I could come up with on short notice. Sorry.
Okay. So we're continuing the deposition of Jerry Goodman, who has been making the case that it may be possible to materially improve someone's long-term financial future and how the dividend growth strategy is their main focus to accomplish that. We took a recess after the last PodCLASS when Jerry Goodman had explained why he continues to harp on the dividend growth strategy that has a long history of excellent performance with lower volatility.
And you got to love it. Hey, we also discussed FOMO, F-O-M-O, or the fear of missing out, which is the biggest objection to this dividend growth strategy we're explaining. And in case you're wondering, FOMO also relates to the fear of not owning the next Apple, Tesla, Nvidia, or whatever stock market darling might be there at the moment.
FOMO, it's a real thing. So as we continue to depose, remember, we're not disposing of him, we're just deposing Jerry Goodman, the discussion turns to the subject about how bears can be your friends. And we're not referring to Smokey Bear, okay? Or his wife Goldie, or their little son Smokey. We talked about all of them on the last episode. We're just talking about bear markets. This is Megan Hubbard, and with us is my dad, Jerry Goodman, and we're super happy in capital letters. If I can speak in capital letters, that's how I would say super happy you're brave enough to join us. I'm a former first grade teacher at Christian Academy of Knoxville, and Dad's the former controller of Wendy's of Knoxville. Did that mean you controlled people eating hamburgers?
I'm very controlling. Yeah. We'll talk about the menu, which had a flaw in it at one point in time. But yeah, I was in charge of keeping up with the money.
Oh, I was thinking you were counting hamburgers or something.
Well, no. But there's lots of Wendy's stories I can tell you. But yeah, just sum it up and say I was in charge of the money, keeping up with everything,
right.
making sure the debits equal the credits. Yeah.
That sounds riveting. Well, was it?
Not really.
Oh, okay. Well, never mind.
It was kind of boring.
I would have just been eating all the French fries and the hamburgers. But anyways, I have a master's degree in curriculum and instruction. So for our discovery process, I have the role of the question asker. And if you've been listening to us, you know that we have to put 7 ers at the end of asker.
Mm-hmm.
Dad has over 40 years. What?
Nothing. I was just going to say you're right. 7. You can round it up to 8 if you wish on asker.
I'm good with 7. Dad has over 40 years of experience in the financial services industry. And so for this discovery process, who better than he to be the deponent, also known as the question answer. Y'all can count those and make sure I said 7. So hear ye, hear ye. You don't need to rise because court is still not in session, and we'll continue deposing our deponent. The matter before the PodCLASS includes organizing your investments and is it possible to materially improve one's long-term financial future? So, Mr. Dad, you're still under oath from the deposition that started way back in PodCLASS number 16, okay?
Sure, I am, but I'm happy to re-oath myself in case it's necessary.
No, you're good. But swear you won't tell any of the jokes that you think are funny.
Well, I'm not so sure I can agree to that. But anyway, let's just move on. I'll tell the truth about everything, and if a joke sneaks in, I have to plead No
Guilty.
contest? Yeah, something. I'll come up with a plea of something.
Guilty of telling jokes that are not funny.
Yep.
Anyways, well, Mr. Dad, this whole deposition got started because you've not only been accused of constantly repeating certain things in these pod classes, but you've even pled guilty to it and have vowed to continue down this path.
Well, it's not like I killed somebody, is it?
You might be guilty of boring someone to death.
Yeah, but wouldn't that just be manslaughter or maybe woman slaughter, depending on who actually died?
Well, now for someone who just is joining this deposition, maybe you want to start with podcast number 16 when all of this began. So, as I review your prior testimony, you said that dividend growth is a strategy of investing in well managed companies with a history of raising their dividends each year.
That is correct.
And you also
Question asker.
Well, you also provided evidence that the strategy has been very successful. So we'll give you that.
Yes. And we talked about Exhibit A, which is a research list from Wells Fargo Investment Services called the Diversified Stock Income Plan, or we like to refer to it affectionately as DSIP, DSIP, because it's shorter.
And DSIP is a dividend growth strategy?
Yes, it is. And going back to 1993 is that's when it was born. The performance, it's been 12% a year for over that 30-year period. And the S&P during that same time frame was up about 9.6% for the same period. So that's an excellent track record. And we also have Exhibit B as in boy. That's a Ned Davis research report that's also on our website. And it shows the outperformance of this same dividend growth strategy over an even longer period of time than 30 years.
And let the record show that exhibits A and B are both on the investments page of the website that we have, theorganizedinvestor.com.
So let's remind everyone about Exhibit C, as in Charlie. And this basically is what we're going to refer to as pod classes 11 and 12. So if you haven't listened to those, this is where we explained the 84 advisory accounts that we managed and for at least a 5-year period that also focuses on this same dividend growth strategy.
So what is there to actually learn from all of this? What is there to take away?
Well, the takeaway is through January of 2024, we calculated this out. The average net rate of return after any kind of fees or expenses related to that, the net return to the client for these 84 different accounts was 14.06% a year, again, for that 5-year period. Now, if you extrapolate that forward just over a 5-year period, that's equivalent to an increase of about 92%, which it's not a double in value, but it's close.
Okay, so what should the listener do with that information?
Well, for starters, a listener should just simply compare their own performance. Like, what has that been over the last 5-year period? And if it happens to be less than 14% a year, or if it's not even close to, say, doubling in value, well, you could say they maybe have some room for improvement. And if they don't know, we're also happy to help them find out by reviewing their statements if they're willing to let us help them with that.
Now, this deposition began because you keep repeating this dividend growth strategy in these pod classes, and you just did it again.
And here's why we did it again. First, this dividend growth strategy, this is the most consistently profitable investment strategy I have ever found, ever, period. Okay, I've been doing this for over 40 years. This one's the king of the hill. Next, after I was initially educated or introduced to this, if you will, it took little bitty me about 6 months to finally realize just how beneficial this can be for virtually any investor. And much of this just simply won't sink in for many people, including myself, until they hear it a number of times.
So you're saying you're a slow learner because we've covered this last podcast.
Oh, you're bringing that up again. Maybe. Because, and I'll say this, back in 2007, I had a friend in the office. He had to pester me about this DSIP list until I finally realized, just how well the thing had done. So if I don't keep harping on this, it's not going to get somebody's attention. And so this time next year, they may be still getting the same mediocre return they're getting right now. So I feel kind of obligated to say, look, this is important. This is a big deal. Turn your ears on and pay attention to this.
So let's harp on something else for a few minutes, okay? And I think the topic is about how bear markets can be your friend. Can we talk about that? This should be interesting.
Well, yeah. Let's pick a new thing to harp on. Frankly, I have pondered how to explain this for months and months, not years and years, but let's say months and months. And I think it's finally time to unwrap this. So be prepared for a lot of disclaimers and footnotes because our opinions about bear markets, these are not as concise and structured and organized as just the dividend growth strategy, okay? But that's okay.
So, can you start off with what a bear market actually is?
Sure. It's basically if you've ever been up to the Gatlinburg and you need to buy, oh, no, I'm talking about buying bears.
No.
A different bear. Just trying to be funny. Look, most people when they think of a bear market, they think that stock prices have declined. But let's dig a little deeper and divide these market pullbacks into a couple of different little categories. Okay. Now, as we're going to refer you once again to the investment page of our website, which is theorganizedinvestor.com. You're going to find that we're just going to call this Exhibit E, as in Edward, which is a summary from the Hartford Mutual Fund family, and the title of it is 10 Things You Should Know About Bear Markets.
I bet they really only had 9 things to know, and they just made up one more to get to 10. What do you think?
That's probably, or maybe they only had 8 and they made up 2 more. But keep in mind, take some comfort in the fact we're not going to cover all 10 of these, okay? But like we did in the last pod class, Megan, how about you read some of these on this list? How about you read number 1 for us? Because you're better to listen to than I am.
Okay, so here we go. And this is from the summary titled 10 Things You Should Know About Bear Markets, which is on the investments page of our website. Number 1, watch for 20%. Market cycles are measured from peak to trough. So a stock index officially reaches bear territory when the closing price drops at least 20% from its most recent high. A lesser decline in prices is called a market correction and is a drop of 10% to 19.9% from the most recent high. A new bull market actually begins when the closing price gains 20% from its low.
Fabulous. You did great. I couldn't have done that better myself, which is why I had you do it. So let's round this off just a little bit, and let's just say, to keep it somewhat simple, a correction is a decline in the market between, let's just say 10 and 20%, okay, from the high. A bear market is a decline of, let's say, 20% or more, and we'll forget about that 1/10 of a percentage point. And a bull market is when stocks are 20% above their most recent low, okay? So how about read number 2 on the list?
Got it. Number 2, stocks lose 35% on average in a bear market. And in contrast, stocks gain 114% on average during a bull market.
So the fact is, on average, the gain in a bull market is almost 3 times more than the loss in a bear market, which that's some good news. Now, number 3 is not that helpful. So, Megan, let's just skip over to number 4, if you would read that one for us.
Okay, that really hurts my brain that likes things to be in order. But number 4, bear markets tend to be short-lived. The average length of a bear market is about 0.8 years. That's significantly shorter than the average length of a bull market, which is 2.7 years.
So the bull market, which when it's going up, will last about 3 times longer and make about 3 times more than a bear market. So let's skip down to number 6. I know it's going to trouble you, but
once again, skipping around.
Sorry.
Number 6, bear markets have been less frequent since World War II. Between 1928 and 1945, there were 12 bear markets, or one about every 1.5 years. Since 1945, there have been 15, one about every 5.1 years, every 5.1 years.
Couldn't have said it better myself. Actually, in that case,
5 years and 1 month, right? Is what we're saying there.
Approximately.
You're quickly climbing the learning curve by listening to our Organized Investor PodCLASS. Your instructors are Megan Hubbard and her favorite dad, Jerry Goodman. Listening to at least 12 pod classes is recommended, and it also helps to subscribe on your podcast platform.
So as you listen to all of this, you may be thinking, well, that's really great, Jerry, but how's this going to help me? And the answer is, it probably won't if your portfolio is being managed like so many others that we see on a daily basis, okay? It's not going to make any difference to you. We've been continually harping on the fact that this dividend growth strategy, it not only has a better long-term track record than the S&P 500 index, but it also has less volatility. It bounces around a lot less.
So let me remind the pod class that you testified earlier that less volatility actually means the stock prices don't fluctuate as much as many other parts of the market. So in technical terms, you called that less bouncy aroundy.
You're absolutely right, Dee. Uh,
Very technical.
yeah, it is. And that's what we try to do here. And that means basically when the market drops, say, between 10 and 20%, that's called a correction. A decline of more than 20%, it's called a bear market. So when that happens, having a portfolio of dividend growth stocks, for example, that probably didn't drop as much as the overall market, that gives you a bargain opportunity, right?
So exactly how does that work?
Okay, I'm going to give you a couple of examples of how this has helped our clients. And we're going to cover the first one in this pod class, and we're going to get the other one in the next episode. So, and whenever I share either of these examples, it concerns me. And I want to cover a couple of disclaimers and some footnotes, if you will.
So that sounds really official.
It is official, but a bargain opportunity, let's talk about this. A bargain opportunity may not be appropriate for every client, and not every client may be interested in them for themselves, okay? Next, each opportunity is going to be different than every other one in the past. So there'll be some probably be both random, they'll be unpredictable in terms of, how to profit from them. That's really what that is.
So basically, you're saying there's no way to know what the next opportunity is going to look like and when it may pop up. Is that right?
Yeah. And I wish I could predict it, but you can't, okay? We have two examples. And again, the first one, let's go back to March of 2020, when our favorite little, virus of the century, COVID, happened to show up. And the market went down into bear market territory, which basically, when it got into that territory, it lasted only 33 days, okay? And it had dropped about 33% in value very, very quickly. It was kind of like the movie, with that same name. The drop was Fast and Furious. I didn't see that movie, but I've heard of it.
There's like 12 of them, so you need to catch up.
I've missed a bunch of movies.
So you considered this to be a bargain opportunity?
Yep. It was a classic case. So the first thing that we did at that time, we took any available cash that we might have in some of these advisory accounts, and we added it to these dividend growth stocks, which were already there. We just kind of increased our position because we didn't want it to be in cash. So it wasn't a huge amount of the portfolio, but again, it did need to be in a money market fund because all of a sudden things were super cheap.
So what happened next?
Well, about a month later, I walk in. I literally was pondering this one morning about what we owned in these advisory accounts, versus what had happened in the market as a whole. So literally one morning I asked myself, and I said, "Self, why do we own all this Smucker's jelly that probably dropped maybe 2% in price versus some other companies out there that have dropped as much as 75 or 80%? That was the question. It was a literal question, like, why do I have this?
That's a really big question for early in the morning.
Well,
you're a morning person.
Well, it's a big question for kind of any time of the day. And it may sound like an obvious question, but the market had just experienced something that had never happened before. I mean, parts of the whole country literally were shutting down, and nobody really knew ultimately what the outcome was going to be. So I go and download this massive research list of every stock we have in our database, which was several thousand companies that we had an opinion on. And we started sorting it out. And the first thing we looked at the year-to-date performance. In other words, so the stocks that were down the most, since the first of the year, were at the top of the list. And the ones that were down the least, like say the Smucker's jellies of the world, they were down near the bottom of the list.
Was the price drop the only criteria?
Well, it was the first one. But if you go down the list, we also considered things like the analyst ratings, like do they like it or not? I mean, what was their price target based, what they thought maybe the stock was at 10 and they thought it would go to 20 or 30. We looked at a variety of different things to see, what did they like, what was down a lot, what had some good upside potential, what looked financially sound. And as you would expect, at the top of the list were things like airlines, cruise lines, restaurant companies, casinos, movie theaters. If it was hospitality related or travel related or anything related to aviation, it was going to be at the top of the list.
So these stocks weren't part of your dividend growth strategy, were they?
Well, looking back on it, there was a few of them that ended up on the list that were affected. I mean, you have good companies that can get swept up into some of these things, but most of these bargain opportunities, as we looked at it, they were massively different than these dividend growth stocks in their account. So I started having discussions with clients to see, hey, would this be of any interest to you? Because I had a little idea to work on with them.
Okay, so that makes sense.
And so the conversations with the clients, they kind of went like this. They would say, look, rather than owning like 2% of each of these 48 dividend growth stocks in your account, how would you feel about owning 1% each of those same 48 dividend growth stocks, and us putting 1% in each of these other, we'll call them COVID affected stocks, as we call them, okay? So you would still have 90%, 96% invested in stocks, and half of it in the less volatile stocks, like from the DSIP list. And the other half would have a lot more upside potential because a lot of these stocks were trading at or near their low in price for the whole year.
So I know I'm going to ask this question because I'm sure everybody is curious. Did everyone want to do this?
Well, for everybody that we mentioned, I think we had 3 people that said, sure, it's a great idea, but they didn't want to do it. So, which is fine. Because I wasn't in a position, I didn't have the interest to start trying to convince people that, this was the thing that they needed to do. I mean, I thought it was a great idea. I was very confident it was going to work. But I mean, you weren't sure about certain things. We weren't sure about this. We didn't know really how long it was going to take. But we did realize that we were kind of spread out, very diversified over a lot of different things and about a lot of different companies that had maybe 3 months before were trading at a much higher price that we didn't think were going to go out of business.
So for everyone that did allow you to do this in their account, can you tell this podcast how much they made?
Oh, I could give some numbers, but I'm not going to give you actual numbers for a couple of reasons. The first, this is one of those one-off situations that will probably never happen again, at least like this. And since it's not predictable, it's not recurring, I don't want anybody to expect, hey, we can do this sort of thing every year. It's like, gee, we need a pandemic like the COVID thing every year because
No,
we
thank you.
We make a lot of money. So that's the first reason. The other is, many of these trades were so profitable. Someone literally wouldn't believe they're true. So we're not even going to say that, okay? But let's just put it this way: we had some clients that 18 months after we started this, that they were happy campers. The outcomes have been very, very good.
Well, Mr. Dad, this deposition is to make your case that it may be possible to materially improve someone's long-term financial future and your focus on the dividend growth strategy. So, since you've been harping on this for several episodes now, did this improve the financial future for those clients?
Let's explain it this way. We had a number of clients and some of these trades had to be done because that's where the bulk of their money was. We did them in what's called a taxable account. Now, when I say that, I'm saying it's something that's not an IRA. And so because it's taxable, anything that goes on in that account, if you buy and then sell something, the trades, are going to create a taxable event. So in the fall of 2021, which was about 18 months after we bought a lot of these things, I started having discussions with the CPAs of several of these clients. That basically, I was just kind of forewarning them, this is how much gain that they may end up on the tax return of 2021. And if some of it, just to see, do we need to defer some of this into the next year, which is 2022. So obviously, the tax deferred IRAs, as an example, if they weren't an issue because there's no tax effect on that, but the other accounts, we had to alert some of the CPAs out there, just to expect this is what's about to happen because of how profitable some of this stuff had been.
So what you're telling this PodCLASS is that it worked.
Absolutely. And some of the 48 COVID stocks, obviously, some have made more money than others. Some of them recovered in price quicker than others. But there's nothing really unusual about that. Also, none of these were purchased. We didn't get any of them at their absolute low point. We didn't sell them at the absolute high point. But there was plenty of profit in the middle, between when we started this and when we got out of some of these things.
You realize this is the 18th PodCLASS you've created. So why did you wait until now to share such a great success story?
We've been harping on the fact that this dividend growth strategy is the most consistently profitable strategy we've ever found. And it probably will have less volatility. That's been our experience. The fact that we have the trading ability and the knowledge to take advantage of these types of, we refer to this as a bargain opportunity. It's great for our clients, okay? We made a lot of money off this personally as well because we own many of these same things ourselves. But the dividend growth strategy is the main course and it's the most important part of their meal. And this little bargain opportunity, like with COVID, when it showed up, just prefer that as dessert, okay? It was a nice dessert, a great dessert, made a lot of money, but it's really not what we focus on kind of on an ongoing core strategy basis.
Now, in every PodCLASS that we discuss your 5-year track record of 14.06% per year, we remind listeners we're happy to share this documentation to back all of that up. Do you have some documentation with these COVID stocks?
We do. But the information on this advisory account performance we looked at differently than just a lot of the individual trades that are done on these COVID stocks. So yes, we have information like that to share with somebody if they'd like to see it.
So, what should the main takeaway be for the podcast listener?
Once again, let me harp on the fact, and you're getting tired of hearing this, but it's important. The dividend growth strategy is our main focus, and just by itself, it has a real possibility to materially improve someone's long-term financial future, period. The fact that we manage these accounts with individual stocks, it may be less expensive and have much more control than, say, mutual funds, which, it's because that's why we're in a position to take advantage of these bargain opportunities.
So there's a possible dessert, if you will, with the main course.
Yeah, that's a good way to put it. And it's possible because when our clients own these dividend growth stocks that are not as volatile as, say, the overall market, there's also a chance to take advantage of a bargain opportunity when they pop up.
And once again, exactly who are you harping on?
Well, the first group is really somebody that's not a client. That's kind of obvious. The other group can be the families of our current clients, because first off, they need to understand what we're doing with their parents' future inheritance. That's probably one part of this. Also, this may help them with their own investments and help them now, not some 20-year period down the road.
The podcast appreciates the fact that was very quick and concise.
Well, after you say it a couple hundred times, it does get a little easier. You get kind of used to saying it in as few words as possible.
I guess so. So on the subject of you harping on things, you spent a lot of time on estate planning quite a few pod classes ago.
Good memory, and it was actually episodes 4, 5, and 6 when we got into that. We discussed organizing your affairs and how we can save someone about $1,000 by working with a local estate planning attorney for a flat fee.
And those will be a good start for people
Absolutely.
to go and listen to?
Yep. And I don't suggest this, but I challenge everybody to, in particular, listen to PodCLASS number 6, okay? If you're even halfway interested in using a revocable living trust, listen to PodCLASS 6. And I kind of jokingly tell everybody, when you die, they're supposed to put you 6 feet under. At least that's the term that comes with that. So in reference to that, listen to PodCLASS number 6, which refers to being 6 feet under.
That's such a lovely, uplifting thought. Yeah,
it's a real visual.
Oh boy, I do not want to be 6 feet under. By the way, just for all the PodCLASS listeners, if I die, I need my family to know. I just want you to just cremate me and put me in a little jar, and then I want my sister to have to carry me around with her everywhere she goes for the rest of her life. So
maybe she could press you into a ring, and she can wear you around.
Oh, maybe that's a good idea, because she could possibly leave me. You need to tell the story about the ashes getting left at the hospital sometime on a different PodCLASS.
Yeah.
From Mom's hospital story.
That's true.
Anyways, I digress.
Someone left Aunt Debbie in the hospital room when they checked out. Not good for Aunt Debbie.
Yeah, so good idea on the necklace. I'll just get myself in like a little vial. She can wear it around her neck.
Okay.
All right. We've gotten off topic here. I've gotten way off in left field. But anyways, as usual, we've covered an earful in this PodCLASS, and we'll continue to depose Mr. Dad in the next episode to hear about the bargain opportunity that happened in 2023. So, is there anything else we need to cover before we take a recess for the day, Mr. Dad?
Let's see. As usual, I know the listeners are dying to hear us say that the rates of return we shared are for informational purposes only, and that past performance is no guarantee of future results. They're dying to hear that, and they just did.
Well, that wasn't the first time they heard that, was it?
You're right, and it won't be the last as they listen to future classes. The returns for each of our clients can also vary based upon the client's individual circumstances, such as when they started the account, what their investment objectives were or was, and all of that sort of thing.
So anything else? This is your chance.
Sure. Here's the big summation. The rates of return for our advisory clients were compiled from a month-end performance report for each of the 190 accounts respectively, my favorite word because it has an LY on it, and is way too much information to place on this website or place on our website in any sort of understandable way.
Well, thanks for not going through all 190 accounts and for not telling any jokes in this part of your deposition. That was, I know, tough for you.
I know, it's a struggle.
Listeners, please feel free to contact us with any questions you may have. Also, be sure to follow us on social media, such as YouTube, LinkedIn, Twitter. Actually, it's X. I keep calling it Twitter. Drives me crazy when people, why change the name? It's Twitter.
I think
Anyways.
they were just being trashed with the name, so they just thought to change the name to protect the innocent or the guilty.
To X, and I don't understand the. Anyways, that's a whole nother PodCLASS. Save us to your favorite PodCLASS player to receive reminders of future episodes. We have more to share, which means you have more to learn. So join us next time. And as always, thanks for listening. And this PodCLASS is dismissed, recessed, and adjourned. Until next time.
And remember, Megan, only you can prevent forest fires.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.